Good afternoon, ladies and gentlemen, distinguished members of the press. The Monetary Policy Committee met on the 25th and the 26th of July 2016 against the backdrop of fragile global and domestic economic and financial conditions. The committee evaluated the global and domestic macroeconomic and financial developments in the first 7 months of 2016 and the outlook for the rest of the year. In attendance were 8 out of 12 members in the MPC. Committee noted the continued sluggish growth in global output being underpinned by weak demand and slowing productivity. In addition to existing risks, rising debt levels in the emerging market economies, volatile financial markets, and the vote of the United Kingdom to exit the European Union have lessened the prospects of a more prosperous global economy in 2016. Consequently, the International Monetary Fund in July 2016 further downgraded its baseline forecast for global growth to 3.1% from 3.2% in April. The Organization of Economic Cooperation and Development (OECD) forecast for global output in 2016 is even less optimistic at 3%. Slower global growth prospects is traced to weak trade, sluggish investments, protracted weak aggregate demand, and low commodity prices that have translated to output declines in the emerging market and developing economies. The Brexit vote has created widespread uncertainty and further elevated volatility in the global financial markets. The United States economy grew at 0.8% during the first quarter of 2016, though much lower than the 1.4% growth recorded in the last quarter of 2015. The tapered growth was attributed to the goods sector, which continues to struggle under the weight of declining factory activity. The hitherto resilient service sector is now losing steam, while trade remains under pressure from a strong dollar and weak domestic demand. Japan grew at an annualized rate of 1.7% during the first quarter of 2016, a reversal of the negative growth recorded during the fourth quarter of 2015. The Bank of Japan, at its 15th and 16th July meeting of the Monetary Policy Committee, maintained its monthly assets purchase program at 6.7 trillion yen, about $63.93 billion, leaving the policy rate also unchanged at negative 0.1%. The euro area grew by 0.6% during the first quarter of 2016, up from 0.3% recorded during the fourth quarter of 2015. Downside risks to the growth outlook have, however, risen following the Brexit vote. The Governing Council of the European Central Bank, ECB, at its meeting of July 21, 2016, retained its key interest rates on the main refinancing operations, the marginal lending facility, and the deposit facility at 0%, 0.25%, and minus 0.4% respectively, with the expectation that they will remain at present or lower levels for an extended period of time. The European Central Bank also sustained its monthly assets purchase program of 80 billion euros until March 2017, with a possibility of an extension. In anticipation of and to mitigate the impact of Brexit vote, the Bank of England voted to continue its £375 billion monthly assets purchase program, financed through the issuance of reserves and possible increase in the quantum should the need arise. The bank also retained its policy rate at 0.5%, with a commitment to stimulate inflationary growth towards its 2% long-run path. The bank also hinted at a possible further easing of monetary policy in August 2016. Major emerging market developing economies continue to face declining capital inflows, rising financial costs, and geopolitical tensions, all of which pose constraint to growth. Depressed commodity prices continue to tilt the balance of risk towards the downside, thus dampening prospects for near-term economic and financial recovery in the AMDs. Consequently, the IMF, in its World Economic Outlook report of July 2016, downgraded the 2016 growth forecast for this group of countries to 4.1% from 4.3% April projection. In July, oil and other commodity prices rallied against the backdrop of better than expected economic data on China in the second quarter, sustained attacks on oil production facilities in Nigeria, and continued unrest in Libya. Nonetheless, global inflation remains subdued despite widespread easing of monetary policy. In advanced economies, recent developments such as Brexit has increased the uncertainty surrounding the future of the Eurozone, thus further weakening demand and suppressing inflation. Consequently, while the stance of monetary policy in most advanced economies is expected to remain accommodative through fiscal period of 2016 in the emerging market developing economies, it is expected to remain mixed, reflecting diversity and multiplicity of shocks confronting them. Domestic economic and financial developments. The Nigerian economy is still saddled with effects of the shocks of the first quarter of 2016, which led to a contraction in output arising from energy shortages, high electricity tariff, price hikes, scarcity of foreign exchange, and depressed consumer demand, among others. Whereas the influence and persistence of some of the factors waned in the second quarter, it is unlikely that the economy rebounded strongly in the second quarter as setbacks in the energy sector continued, owing mainly to vandalism of oil installations. In addition, the implementation of the 2016 budget in the second quarter remained slower than expected in the second quarter. The committee noted that most of the conditions undermining domestic output growth were outside the direct purview of monetary policy. It nonetheless hopes that the regulation in the downstream petroleum sector and the liberalization of the foreign exchange market would help bring about the much-needed relief to the economy. Data from the National Bureau of Statistics indicate that domestic output in the first quarter of 2016 contracted by 0.36%, the first negative growth in many years. This represented a decline of 2.47 percentage points in output from 2.11% reported in the fourth quarter of 2015 and 4.32 percentage points lower than the 3.9% recorded in the corresponding period of 2015. Aggregate output contracted in virtually all sectors of the economy, with the non-oil sector recording a decline of about 0.18% compared with the 3.14% expansion in the preceding quarter. Agriculture and trade were the only sectors with positive growth at 0.6% and 0.4% respectively, whereas industry, construction, and services contracted by 0.93, 0.26, and 0.08 percentage points, respectively. Committee noted a further rise in year-on-year headline inflation to 16.48% in June 2016 from 15.58% in May, 13.72% in April, 12.77% in March, and 11.38% in February. The increase in headline inflation in June reflected increases in both food and core components of inflation. Core inflation rose sharply for the fourth time in a row to 16.22% in June from 15.05% in May, 13.35% in April, 12.17% in March, and 11% in February, and 8.80% in January, having stayed at 8.7% for 3 consecutive months through December 2015. Food inflation also rose to 15.30% in June, from 14.86% in May, 13.19% in April, 12.74% in March, 11.35% in February, 10.64% in January, and 10.59% in December 2015. The rising inflationary pressures was largely a reflection of structural factors, including high cost of electricity, high transportation costs, high cost of inputs, low industrial activities, as well as higher prices of both domestic and imported food products. The Monetary Policy Committee expressed strong support for the urgent diversification of the economy away from oil to manufacturing, agriculture, and services, and called on all stakeholders to increase investment in growth-stimulating and high employment elasticity sectors of the economy in order to lift the economy out of its current phase. Monetary, credit, and financial markets development. Broad money supply M2 grew by 8.26% in June 2016, a 4.80% points increase from 3.46% in May, compared with 0.54% contraction in June 2015. When annualized, M2 grew by 15.52% in June 2016 against the provisional growth benchmark of 10.98% of 2016. Net domestic credit (NDC) grew by 12.52% in the same period and annualized at 25.04%. At this rate, the growth rate of the net domestic credit exceeded the provisional benchmark of 17.94% for 2016. There was no change in the level of banking sector net credit to government in June, contracting by 31.45% growth in May. Credit to the private sector grew by 14.45% in June 2016, which analyzes to a growth of 28.90%, outperforming the benchmark growth of 13.38% for the year. The Monetary Policy Committee expressed cautious satisfaction over the improved performance of credit to the private sector and urged the bank to ensure that the tempo is sustained in order to stimulate recovery of output growth. The MPC noted that the level of money market interest rates largely reflected the liquidity situation in the banking system during the review period. Average interbank core rate, which stood at 20% on 17th of June 2016, closed at 50% on July 15, 2016. The increase was attributed in part to the newly introduced foreign exchange framework and the mop-up of Naira liquidity due to increased sale of foreign exchange by the CBN during the period. Generally, the period under review witnessed a decline in volume of activity in the interbank market owing to injections by the FAC and maturity of some CBN securities. The MPC also noted the decline in the indices of equity segment of the capital market. The all-share index declined by 6.55% from 29,597.79 on June 30, 2016 to 27,659.44 on July 22, 2016. Similarly, market capitalization declined by 6.26% from 10.17 trillion naira to 9.50 trillion naira during the same period, and relative to end of December 2015, the indices fell by 3.43% and 3.55% respectively. Globally, however, the equities market remained generally bearish in the aftermath of the Brexit vote. The external sector developments. The MPC noted the actions taken by the bank as part of the implementation of the flexible foreign exchange market regime decided at its meeting in May, which was designed to improve liquidity and stabilize the foreign exchange market. The bank introduced a flexible exchange rate regime in the interbank introduced a Naira-settled over-the-counter FMDQ OTC trading platform, adopted two-way quote trading platform at the interbank foreign exchange market, and appointed foreign exchange primary dealers. However, the average Naira exchange rate weakened at the interbank segment of the foreign exchange market during the review period following the liberalization of the market. The exchange rate at the interbank market opened at 197 Naira to the dollar and closed at 292 Naira to the dollar, with a daily average of 244.95 Naira to the dollar between May 25 and July 19, 2016. The initial weakness was attributable to the normal market reactions to a new regulatory reform. The MPC reaffirmed its commitment to its statutory mandate of achieving a stable Naira exchange rate. The Monetary Policy Committee's considerations. The Monetary Policy Committee recognized the weak macroeconomic environment as reflected particularly in increasing inflationary pressures and contraction in real output growth. In view of this, the MPC underscored the imperative of coordinated action anchored by fiscal policy to initiate recovery at the earliest possible time. Members called on the federal government to fast-track the implementation of the 2016 budget in order to stimulate economic activity, to bridge the output gap, and create employment. In the same vein, MPC expressed concern over non-payment of salaries in some states and urged action in that direction to help stimulate aggregate demand. On its part, and as a complementary measure, the MPC restated its commitment to measures and deployment of relevant instruments within its purview to complement fiscal policy with a view to restarting growth. The committee also enjoined deposit money banks to partner with government and the bank in this direction by redirecting credit from low employment generating sectors to those capable of supporting growth, reducing unemployment, and improving citizens' standard of living. Members agreed that the economy was passing through a difficult phase, dealing with critical supply gaps, and underscored the imperative of carefully navigating the policy space in order to engender growth and ensure price stability. The MPC therefore summarized the two policy options it was confronted with as restarting growth or fighting inflation. The MPC was particularly concerned that headline inflation spiked significantly in June 2016, approaching twice the size of the upper limit of the policy reference band. The committee noted that inflation had risen significantly, eroding real purchasing power of fixed income earners and dragging growth. The MPC was further concerned that while the situation called for obvious tightening of the monetary policy stance, the recession confronting the economy and the prospects of negative growth to year-end needed to be factored into the policy parameters. The arguments in favor of growth by the committee members were anchored on the premise that the current inflationary episode was largely structural. In particular, members noted the prominent role of cost factors arising from reform of the energy sector, leading to higher domestic fuel prices and electricity tariffs, and prolonged foreign exchange shortages arising from falling oil prices, leading to higher input costs, domestic fuel shortages, increased transportation costs, security challenges, reform of the foreign exchange market, reflected in high exchange rate pass-through to domestic prices of imports. Consequently, the current episode of inflation being largely non-monetary but largely structural, tightening at this point would only serve to worsen prospects of growth recovery, as the bank had in June 2016 withdrawn substantial domestic liquidity through the foreign exchange market upon the introduction of the flexible foreign exchange rate market regime. Members, however, noted the negative effects of inflation on consumption and investment decisions and its defining impact on the efficiency of resource allocation and investments. The Monetary Policy Committee further noted the prolonged non-payment of salaries, a development which has affected aggregate demand and worsened growth prospects. It also noted that at the May NPC meeting, members weighed the risks of balance of probabilities against growth and voted to hold, allowing fiscal policy some space to stimulate output with injections, but this has been long in coming. MPC also, on another hand, considered a high inflationary trend which has culminated into negative real interest rates in the economy, noting that this was discouraging to savings. Members also noted that the negative real interest rates did not support the recent flexible foreign exchange market, as foreign investors' attitude had remained lukewarm, showing unwillingness in bringing in new capital in under the circumstance. Members further noted that there existed a substantial amount of international capital in negative yielding investments globally, and Nigeria stood a chance of attracting such investments with sound macroeconomic policies put in place. Consequently, members were of the view that an upward adjustment in interest rates would strongly signal not only the bank's commitment to price stability, a major mandate of the central bank, but also its desire to gradually achieve positive real interest rates. Such a decision, it was argued, gives impetus to improving the liquidity of the foreign exchange market and the urgent need to deepen the market to ensure self-sustainability. Members were of the opinion that this will boost manufacturing and industrial output, thereby stimulating growth, which is desired at this time. The committee's decision. The MPC, recognizing that the bank lacked the instruments required to directly jumpstart growth and being mindful not to calibrate its instrument in such a manner as to undermine its primary mandate and financial system stability, in assessment of the relevant issues, was of the view that the balance of risks remains tilted against price stability. Consequently, 5 members voted to raise monetary policy rate, while 3 voted to hold position. In summary, the MPC voted 1. To increase MPR by 200 basis points from 12% to 14%. 2. Retain the CRR at 22.5%. 3. Retain the liquidity ratio at 30%. And 4. Retain the asymmetric window at plus 200 basis points and minus 500 basis points around the MPR. Thank you for listening.
Thank you, Governor. Distinguished ladies and gentlemen, that was the communique of the MPC for July 2016. Our house rules still remain. We have to limit our comments and our questions to the subject matters raised in the communique.
And let me say this. Notwithstanding the fact that MPC voted in the direction of increasing the MPR, the Central Bank of Nigeria's development finance focus remains in place. We would, through target interventions, continue to support disbursement of funds through intervention to certain targeted sectors of the economy, particularly agriculture, the mineral sector, those who want to go into new and fresh manufacturing, importation of plants so as to boost manufacturing and industrial output, like we said in the course of the communique. So notwithstanding that, yes, generally you find that maybe by the fact that MPR had moved on by 200 basis points for specific reasons that have been highlighted in this communique, the central bank remains committed to boost through targeted intervention and through its anchor borrower programs, not only for rice but also for tomatoes and other agricultural produce where we see potentials for strong comparative advantage in the country. I thought I should underscore that. Thank you.
Thank you, Governor. As usual, if you have any questions, but the communique is so clear. If you have any questions, you can come up, tell us your name. Please, one question, because it appears so many people will be asking questions. Tell us your name and the organization you represent, and then ask them. Yes.
Thank you, Mr. Governor. My name is Sala Adejoko from the Nigerian Tribune. Sir, I would like to know your assessment of the new forex regime. How has it been so far? Thank you, sir.
Thank you, sir. Okay.
Good afternoon, Mr. Governor. I'm Nancy, the Anchor Prevention AIT. First, I want to actually know why you actually tilted, as the MPC tilted, to fighting inflation than fostering growth. Then the other question is, the new measure to sell forex to BDCs, what do you want to achieve? Because there seems to be conflicting information. What do you actually want to achieve? The other question, which I think you should also answer, is what is the state of the Nigerian banking system right now? There's a lot
Let's take one after the other. First is inflation against growth.
Yes, inflation against growth. Number two is what do you want to achieve with the measure to sell forex to BDCs? That's against what we have right now. Then the third question is what is the state of the Nigerian banking system? Thank you, Governor.
I'm David Malingandere from Bloomberg News.
Hold on a minute, please. Yes, Bloomberg.
Thank you, Governor. Since you introduced the currency reform last month, have you noticed the coming back of foreign investors into Nigeria's fixed income market and equities? And then secondly, are there any plans...
Have you noticed the return of
foreign participation in Nigeria's fixed income and equities? And secondly, are there any plans to probably review the list of the essential 41 items? Because I think that's also an important context question. Thank you.
Good afternoon, Mr. Governor. We want to hear from Business Day. In addition to what Nancy asked, how are you sure that your decision to begin to sell dollars to BDCs won't fuel arbitrage, which has been a major concern?
How are you sure that sale of FX to BDCs?
Okay. Sorry. I'm
Hold on a minute. Yes.
I'm I report for Vision FM Radio.
FM radio.
Yes, one of my questions has been answered. Also, a follow-up to that on the BDCs. The BDCs complained yesterday that the banks refused to sell to them. Are you doing anything to check this? Thank you.
Mr. Governor, I am Godwin Emefiele. I work with Channels Television.
Yes.
In terms of the number of members that voted, 5 for a raise, 3 to hold, you almost would have run into a 4x4. But fortunately, there was one leg to the other side. So the key question is the 3 members that decided that the rates, the policy rate should be held at 12%. What was the basis for that decision based on the minutes? Why the 3 out of 8 decided that rates should be held unchanged at 12%? Thank you.
Thank you. This is a truckload. One more. Please.
Thank you, Mr. Governor. My name is Matthias. Mine is, I'm seeking for clarification, and I work for the Guardian newspapers. Yeah, we heard that the CBN has withdrawn from intervention by way of supplying foreign. That was why the Naira actually suffered, and that it was based on conditions given by the other stakeholders who said if you don't supply, they would also, if you don't withdraw from intervention, they will not bring their dollars. Is it true? Thank you.
Okay, I think that wraps it up, and we will listen to the governor.
Well, thank you very much. You want to know the CBN's assessment of the new foreign exchange regime? I'd like to say so far, so good, and I want to give an excellent assessment to say that it's been excellent so far, given that we had a 16-month period of, put it very clearly, no activity in the foreign exchange market. And I would say that the results has been good, with a few activities that we're not too happy about, but we feel that in the course of time, because this is just practically like just 1 month since this started, that there is still a lot of room for improvement, and I expect that these positive trends will be sustained. Why did the MPC decide to tilt towards inflation rather than growth? Basically, I think the issues were that, if you notice during the May 24th meeting, MPC decided to say, look, if we look at the balance between inflation and growth, that we should stay with growth, and expecting that growth, because the MPC, monetary authorities, cannot directly influence growth, giving the fiscal authorities the impetus to push forward on growth. But like I read in the communique, MPC members felt that that was still is coming in rather quite slowly. But at this meeting, you will also notice that we took a lot of time to deliberate on whether to favor growth as against inflation. We felt that there was a need, in line with central bank's core mandate, to look at price stability at the time. That if we favor price stability at this time, in which case signal an interest rate movement that will curtail inflation, that when we curtail inflation, a lot more stakeholders' interests would have been sort of met, thereby encouraging, in this case, inflow of capital into the country. And as you have more inflow of foreign exchange into the country, what that does is that it deepens the FX supply base, and by deepening the FX supply base, it makes it easy, it makes foreign exchange available to end users, particularly to the manufacturing sectors, who require raw materials to boost manufacturing and industrial capacity. And we're also hoping that when this is achieved, what you find is that naturally prices will be affected downwards. When you have a situation where foreign exchange is also made available to those who want to import agricultural inputs, insecticides or agricultural plants, it helps to boost the agricultural productivity, and this also helps to moderate the effect on prices downwards. So what this does is it generally creates activity that will boost not just manufacturing and agricultural output, but will indirectly now begin to push growth forward. That was purely the essence of saying, let's push from the direction of taking inflation and price stability as a focus during this meeting against growth. It didn't mean that we didn't have growth at the back of our mind, but we felt let's start by looking at price stability, push towards curtailing inflation, and at the same time, ultimately, seeing how you can achieve growth in the same vein. What is the objective of selling FX to the BDCs? If you recall in January, we said that the Central Bank of Nigeria could not continue to dip its hand into the scarce reserves to fund the operations of the BDCs, which is entirely cash. But we also said in that process that look, that the BDCs are allowed to source their foreign exchange from autonomous sources. We went further to say that central bank itself will seek ways to open the channels where the BDCs can access foreign exchange from autonomous market to be able to continue to do their business and provide a source of livelihood to those who are in that business. Unfortunately, I use the word unfortunately, it took us between January and June to do this. Now, what we feel is that we all know the size of diaspora funds that flow into this country. And we thought that what we should do is that foreign currency that flows into the country through the likes of international money transfer organizations, Western Union, MoneyGram, Riyadh, and the rest of them, that those foreign currency should flow through into the bureau de change market so as to help to moderate and dampen the effects of price. And that takes me to the aspect of where somebody says, will this introduction not lead to arbitrage? Rather, to the contrary. What will happen is that by this, it will moderate the prices in the parallel market, indeed bring it down to the point where it bridges the gap between the parallel market and the interbank foreign exchange market, thereby eliminating speculators and arbitrage from that, and those who are carrying out arbitrage activities in the market. This is the entire sense behind this introduction, and we are optimistic that it will, no doubt, yield its objective. What is the state of the Nigerian banking system? Let me repeat. The state of the Nigerian banking system remains strong. Naturally, when economies face global shocks like the entire world economy is facing today, financial institutions will have their own share of that scratch. No doubt, there has been weakening in terms of capital adequacy. There has been weakening in liquidity, and there has been indeed weakening even in the MPR. But not to the extent that it creates any panic or worry to anybody, any stakeholder in the Nigerian banking industry. So I see this opportunity to say that the strategic health of the Nigerian banking or Nigerian financial system remains strong at this time. There is no need for anybody to begin to panic or worry that any bank is in distress. We took certain actions about the activities or to express our unhappiness over the, I would say, misdemeanor in the activities of certain board and management members of a bank. And doing that does not mean that that bank is distressed. Second, let me say that since 2009, the central bank had always come out to say very boldly that no Nigerian depositor or no depositor of a Nigerian bank will lose its deposit. And we've stood by that to the extent that at a point the central bank even issued guarantees in favor of any depositor or at the interbank market to say, look, we will not allow anybody to lose its money. And that has remained the same. And those guarantees indeed has not crystallized since 2010. But what the central bank will continue to do is to monitor the Nigerian banking system, monitor the activities of directors, monitor the activities of shareholders, monitor the activities of members of management of the Nigerian banks. And when we find that we are not happy with the dealings or activities, or some directors or shareholders have undermined their positions to the detriment of that bank, we would take action by removing that management. We would take action by removing the director. We would take action against that shareholder to see to it that he does not, by his activities or her activities, does not precipitate a distress in that bank. I think depositors and interested stakeholders in the Nigerian banking system should please note the fact that we change the management or board or certain individuals in management or board of a bank does not connote distress of that bank. Depositors of banks are please endure. We appeal to you, go about your business. You will not lose your deposit in any bank. I repeat, the strategic health of the Nigerian banking system remains strong. But we would, I repeat again, take action against individuals, whether in management, in the board, or shareholders of banks who by their activities undermine the success of that bank. But this should not by any means connote that that bank is distressed. Have we noticed the return of FPIs in the banking, in the FX market? My answer is yes. Yeah, it's all foreign exchange inflows and all that. My answer is yes. When it took us 3 weeks from announcement in May to June 20th to take a decision to release the guidelines, that process was extremely painstaking for us. And we said we would like to come up with a document that will be adjudged by every person to be a sound document. And we are very, very delighted at CBN that to date, nobody has faulted the content of that document. I mean the guidelines that we released. Implementation will have a few ups and downs, but I know in the course of time, we will get it right. But what is important is that, I repeat, we came up and introduced the spot, the forward, and the OTC. We brought in an innovation in the OTC futures, where we are saying that if you are worried about volatility, that we provide you with FX futures that will reduce or completely eliminate volatilities for you, and you can be sure that you can procure foreign exchange at a rate that you predetermine in your mind, and that you can go into the foreign exchange market and procure your foreign exchange as you need or as you desire. That is a novel idea, and it is being embraced. The volumes that we see is encouraging, and I am very optimistic that we're in the right direction. Are there plans to review the 41 items? We have always said that the reason we introduced the restriction on foreign exchange in Nigerian foreign exchange market for the 41 items is because we are convinced that these items can be produced in Nigeria. And because of the shortage of foreign exchange to service the needs of everybody, knowing fully well that our revenues in foreign exchange has declined quite drastically, we thought that we should limit access to foreign exchange in Nigerian foreign exchange to these 41 items. And I'm happy to say that it is yielding results. I'm sure the